Good morning, good evening, good day, everyone, wherever you may be tuning in from around the world. Welcome to our very first Bitcoin Capital Markets webinar series. This three-part series is put together to talk about how Bitcoin is moving from a passive asset to a productive yield generating asset, and how that is powered not only by the Bitcoin network and networks like Stacks and others, but how the future looks as Bitcoin begins to awaken and begins to be that productive asset that we know it can be. And with this series, we're going to be breaking it apart in three different parts. Today, we're going to be talking about the institutional shift, looking at everything from the custody side to institutional capital side to the mining side to how Bitcoin becomes productive across the entire Bitcoin ecosystem. I'm your host today, Kyle Ellicott of the Stacks Asia Foundation. And with that said, before we introduce our next panel, I do want to leave you with one exciting stat to kick us off today. As of today, we have over 2.5 million Bitcoin sitting in financial products across capital and equity markets today. That represents about 12% of the total supply sitting across treasury companies and ETFs that today sit idle and very soon may be awoken. With that said, let's go ahead and kick off our very first panel today, everybody. We're going to be talking about Bitcoin from a reserve asset to productive capital and how institutions can begin to think about and activate their Bitcoin. So please, a quick round of applause. Virtually, I can see each and every one of you for our panelists. Let me welcome up Stefan from Blockchain, Adam from Copper, Nick from Luxor, and Rena from Stacks to the stage. Welcome, everybody. It's a pleasure to have each and every one of you joining us from around the world. I want to be conscious of our time, so I'll give each of you maybe a quick 30-second intro, if you can, on your respected companies. Nick, let's start with you.
Yeah, my name's Nick Hansen. I'm the CEO of Luxor. We're a Bitcoin mining services provider. So I'll be representing the miners on the stage, kind of how miners view Bitcoin as a productive asset, what they're doing, what kind of trends we see. So thanks for having me.
Wonderful. Welcome, Nick. Rena, next to you.
Thanks, Kyle. So I'm Rena. I'm with the Stacks Endowment. We are the long-term foundation and treasury for Stacks. And today I'll be representing how we do treasury management, how we actually use the products that the Stacks ecosystem built to generate Bitcoin yield.
Right on. And Stefan.
Hey, a pleasure meeting you guys. Stefan from Blockdaemon. We're an institutional infrastructure provider, so we work with your, leading banks, custodians, exchanges, wallet providers. So we are part of the gateway of this, institutional money into crypto, and I'm representing this, and can hopefully answer some questions, how they see Bitcoin yields, or maybe what to expect for the future.
Wonderful. And welcome. We may have one additional speaker joining us in just a little bit. And Stefan, I want to kick off with you and Blockdaemon. You play a very important role in this ecosystem. And I think it'd be interesting to hear kind of what are you seeing in terms of institutional readiness to move beyond just simply holding Bitcoin. And let's start with that.
Yeah. Okay, I think it's a great question because we're at an interesting inflection point where, the tech is ready. I think we are past that stage where the question is, are there attractive offerings? There are. The infrastructure to, allow Bitcoin to not just sit around but be used is there. And now it's really, the question or thing is we're ahead of the institutions, and I think where they are in terms of readiness, internal readiness and risk appetite. And this basically, goes back to what I said about our customer base. We're not only, but also a staking provider with like over 10 billion staked. We work with your, 5 out of the top 10 US banks and such. So what I can say is everyone who's holding Bitcoin, also from institutional lens, is asking us about Bitcoin yield. So that's the thing, right? The demand is there. However, the readiness is not quite there. And I think I can go into this a little later, but maybe to come back to a question, Kyle. I think what has really changed in the past 6 to 12 months is not only the appetite, but also the institutional confidence. I think this comes down to two major developments that we have seen, right? First, clearly, and I think that's huge, is the regulatory clarity in the US with the current administration. I think, being very pro-crypto, building frameworks that are, clearer when it is about self-custody, stable coins, the Genius Act. So I think removing this regulatory uncertainty will help a lot to bring institutions from the sidelines, more into actually doing things. And second, and this is, and I would hope the others can mirror this. What we are seeing is we are talking to more enterprises and banks than ever and diving really deep, which often is painful, right? Like we're talking due diligence, RFPs and such. They clearly want to familiarize themselves with the topic. They want to learn more about the infrastructure providers where we are one part of the solution. And just get the knowledge so that they can in fact move ahead with confidence. And I think that's really where we are. So the infrastructure is ready. I think the workflows are ready. Stacks is around. There's many different Bitcoin yield solutions depending on what flavor you want. But I think what we're seeing now, institutions are moving. It's not a question of will they do it. I think the question is when and how much. And yeah, I'm really hopeful that we will see more in 26 actually.
I'm going to come back on the workflow thing, but Rena, do you have anything to add on to that?
I'd say that from our perspective, we're getting more and more inquiries on Bitcoin yield on chain. Obviously, Stacks is the leading Bitcoin L2 who's been pioneering this for years on out through proof of transfer and all of our innovations through staking and such. But it's now to the point that people are not only looking to stake their Bitcoin, but they want to borrow against it on chain. We've seen a number of institutions like Tether and others kind of do the off-chain lending, but now people want the transparency again from the 2022 era of what happened with other institutions like Celsius and such blowing up, but you still want to have these loans on chain. And so the way that we see it is that you want the best risk adjusted yield for liquidity against your Bitcoin, and more people are using the protocols that Stacks has built.
Wonderful. And Nick, anything to add on to that as well? Institutional readiness from the mining perspective.
Yes. So miners are some of the bigger treasury companies. If you go and look at who holds a lot of Bitcoin, it's a lot of miners in the top 10 and top 20 of the DATCos. There are a lot of the DATs are looking for yield on their BTC. I would say they are hesitant to wrap it up and move it somewhere. That's kind of the big hurdle for most of them. Sending their Bitcoin to an address, whether it's sBTC or WBTC or whatever it happens to be, and getting the EVM version, whichever chain that happens to end up being on. They're just hesitant to do that because there is this stigma of risk on bridges, and then also on just EVM protocols. For example, Balancer was exploited recently, and that's generally kind of the type of protocol that you're going to be putting that wrapped Bitcoin into, whether it's whatever type of wrapped Bitcoin you have. So you're kind of taking on two risk vectors there that miners and generally most of the DATs are somewhat averse to. As the market matures and gets more, I guess it becomes clearer what the risks are for these miners, and those risks are mitigated in different ways. It becomes more attractive to miners, but right now it seems like they're really looking to get yield in different ways. So rather than wrapping, so that's kind of what we're seeing on the miner side, and some of the DATs as well. There maybe, I guess one famous miner, I guess, would be they actually lent their coins to a market maker that is doing they're selling like covered calls and things like that to generate yield. So that's more of like the TradFi way. But again, you are kind of giving up your keys to that coin and not really holding it anymore. So there is always some risk, and I guess it depends on how much risk you're willing to take as one of these big pools of Bitcoin.
Rena, do you have something to add on that? I saw you unmute real quick. Did you want to add anything to Nick? Good point, Nick, by the way.
Nick, I think your points are fair, and I think a lot of protocols are actually taking the innovation to keep the Bitcoin locked with unilateral exits on the L1, which I think could address the miners' concern about wrapping for like future state. That's the future state where Stacks is going to go, that you can unilaterally exit on the L1 at all times, whether the signer network goes down or anything like that, because we inherently believe that everyone should have access to their own Bitcoin.
Right. Thank you, Rena. Adam, last but not least, from the custody side, how are you seeing this institutional readiness from customers and those that you might be talking to from a perspective side about doing something more than just holding their Bitcoin?
Yeah, I think folks are thinking about a couple of different things in terms of like operationalizing and building out that framework. I think what we've seen, to Stefan's point on the RFP side, certainly post 2022, post algorithmic stablecoin DPEG, post summer of lending failures, post FTX, the DDQ RFP process for a lot of these institutional clients has gotten significantly more in depth. It's become pretty mature from a legal and compliance perspective. So there's a lot of different things that these guys are thinking about. The folks that we face off with, the largest hedge funds, asset managers, prop trading firms, et cetera, those RFPs have gone into, specifically on the custody side, what does the architecture look like? What is the wallet infrastructure? Is it HSM? Is it multi-sig? Is it MPC? What makes the most sense based on the type of transactions you're looking to do? How do you think about the key management? How are assets segregated? Are you going to go cold versus hot? Is it long-term versus, what immediate kind of operational liquidity needs do you potentially have in the space? And then how do you integrate there? I think for a lot of the major institutions that we see, that self-custody model is less and less prevalent and tends to be more of a focus on kind of the centralized setup. But the questions we get asked, typically, when people are trying to think about that infrastructure is what are the legal and the compliance implications? How is Bitcoin treated under local laws? Is it a security? Is it a commodity? What are the AML KYC considerations and controls that exist there? And then how do we anticipate potentially those underlying assets to be rehypothecated? So these are some of the more legal, technical focused items. We see a lot certainly on as folks start to take a more robust approach to risk management and risk management controls. What's the risk monitoring? What operational risk controls are in place, like credit limits, different things like collateral requirements and the like. And then on the tech side, what's the connectivity look like? What is the trading infrastructure in place? What interaction do you have with smart contracts? What is it purporting? And then for those who are leveraging more of like a collateral treasury management function, what is that yield strategy? How is it executed? And then simple things like making sure that your counterparties have the appropriate insurance and the appropriate safeguards there to protect against theft, hacks, operational errors, et cetera. So a lot to consider from kind of the operational requirement perspective, and certainly the stuff that we see from the folks that we face off with as they start to explore how to really unlock Bitcoin.
So Adam, you bring up a very good point that Stefan touched on around workflows. I think we talk a lot about Bitcoin being a productive asset, and it's a great first layer of the onion. And then we're able to talk a little bit about where it could get productive yields. That's another good layer of the onion. But getting a little deeper, workflows. Some of the things that you just mentioned that you walk clients through. Would love to go deeper into that on the operational side of this. So if I'm an institution looking to start moving, we'll use today 1,000 Bitcoin. I'm feeling good. It's the holidays. I want to start moving 1,000 Bitcoin around. What does that workflow look like working with you as on the custody side to start that process? I mean, you were mentioning things like credit limits to trading to risk management. Some of this stuff is just not talked about much outside of maybe internal conversations. So let's throw that out to the world. I have 1,000 BTC in our example today. I want to start moving it. Walk me through that workflow on the custody side.
There's the way that we see folks interact with it. First, I think it's still important to remember that Bitcoin was born in 2008, right? So with the Satoshi white paper, it's still, I think, quite literally a teenager of an industry. So it's still nascent. There's still, I think, areas that are maturing. to your point, helpful to take a step back a little bit maybe and assess how are we seeing institutions typically access Bitcoin yield. So there's a couple of different ways from a custodial perspective besides just kind of the hold and watch for price appreciation and in cold storage. Centralized lending is probably one of the bigger ones that we see across the platform. Utilization where a borrower is just going to deposit some BTC as collateral for a loan. Some of the things that we see that end up, I would bucket more in the DeFi space are deploying wrapped BTC into DeFi. So this is where your sBTC piece comes into play, where you can wrap Bitcoin, you can lend stake, you can provide liquidity on DeFi platforms, again via kind of the lending or the yield farming perspective. So there's the DeFi component of it. Folks are leveraging it through native L2s, through Bitcoin DeFi protocols like Stacks. And then what we're seeing more and more of is folks who are a bit more crypto savvy having the ability to employ across yield aggregators or vaults that are designed kind of to optimize some of those yield farming strategies, or in the case of the vaults, trying to pool funds together to try to generate returns. So there's quite a little bit of it that sits within the DeFi space, and I think a lot of the institutional folks are still. I still think very, very early days on DeFi. I think it's early on crypto journey to begin with, but the DeFi piece is even earlier. But having a team that has the savviness and the know-how to be able to leverage that part of the ecosystem is a huge component to it. I think specifically on the Stack side, right? Rena can speak much more intelligently on this than I can, but the proof of transfer type rewards where you're participating in consensus, lending via the BTC kind of focused protocols or apps, or again the sBTC component via smart contracts. So those are typically the ways that we're seeing the institutional client base start to get a little bit more savvy with their Bitcoin holdings.
Rena, anything to add? I saw you on mute.
I mean, I can't really follow up with that, but I think that's a fair point. Everything requires proper custody and such. Institutions need that. And I think as Stacks moves forward, we're making sure that we work with the right custodians. Obviously, we have Copper here, and then we have our staking providers like Blockdaemon in here, but we're trying to make sure that we activate things as seamlessly, understanding that institutions have different setups than you and me as everyday retail, and we want to respect their setups.
Couldn't agree more. Stefan, same question around workflows. My 1,000 BTC, I want to start moving that as a customer. Is that workflow in place to support the demand of my 1,000 BTC and then that 2.5 million Bitcoin that sits in public markets today?
Look, yeah, I would say yes. Of course, we work with a lot of custodians and wallet providers ourselves, right? Like with Copper as well. So the journey may start at the same position and then it comes over to us. I think, and if you ask me the same question, what do we see? We obviously look at it from a staking perspective mostly. We also dabble a little bit into our other Bitcoin yield opportunities for Bitcoin, just to have the full picture. And I think in this process, where we see the most friction is absolutely not with the technical infrastructure, as said, and also as described well by Adam and also by Rena. I think technically we're there. I feel an issue really is education and maybe standardization. I don't know if that's the right word, right? But so a lot of institutions we work with, when they want to learn about and participate in Bitcoin yields, they have issues understanding how that works in detail. Exactly, what you four were talking about just now. For Ethereum, for Solana, I think, for like standard staking protocols that have their on-chain staking and reward mechanisms, the validator model is pretty understood, slashing risk are understood. So I would say here institutions know which questions to ask and know, where to pay extra attention and understand it in general. However, once they really want to get their feet wet and venture into Bitcoin yields, and this is where I said maybe standardization is the wrong word, but there's so many options that are working differently. And so I think we have two jobs here. One is to, be a helper and an educator and ensure that we, can walk companies through the questions they have. And, for example, Nick also talked about the risks of EVM chains and wrapping and bridging. And there are a ton of questions around that because what's clear as well, I think most Bitcoin holders are extremely scared of taking any risk if they are not holding their Bitcoin anymore, rightfully so. And so I think that's one of the main questions. And where I'm not too sure, if we can have like real standardization in a industry where there's just very different approaches to how to provide these Bitcoin yields. I think what we can do though is, really work together and ensure that there's, at least this sort of assurance for the industry when it comes to security, when it comes to risks and such, that the right companies work together to, have a institutional enterprise ready uh, proposal to these companies that want to venture into it. And this is exactly, where we see ourselves as Blockdaemon, and I think the other participants here as well. What we're trying to is remove as much complexity as we can for our customers. For example, we have an earn stack, and that comes maybe back to your process question, an earn stack, which enables you connected to your wallet and then through this access Bitcoin and also other yield opportunities as seamlessly as possible. To ensure that, at least once you have understood how it works, you don't have to build it everything yourself, but you can easily integrate it. And so it's, then I guess more about risk assessment and taking the leap of faith or making the decision for these institutions to commit, and at least this, hurdle of also building or integrating the tech is as small as possible.
Couldn't agree more. This was a very big topic at Abu Dhabi Finance Week last week. Blockdaemon and Stacks hosted a number of people from the community, and we actually talked to a few family offices and institutions about some of those key points as well, Stefan. So more and more institutions, as you mentioned, are looking towards us and asking these questions. And they're also asking questions around sustainability and the sustainability of yields as well. So Nick, I want to give you a moment, let everyone else take a break
Yeah,
as we've got a few minutes, but talk to us a little about where you're seeing kind of the most sustainable sources of Bitcoin native yields emerge
yeah,
here in
that's
2025.
if you were around during the Terra Luna deep peg and all of that, the question was always, where does the yield come from? In the DeFi summer, and even if you weren't using Bitcoin or any of the wrap variants, there was always the question of like, where does the yield come from? Typically, it just came from emissions of the protocol that you were quote unquote farming, whether that was through tokens or whatever that then ended up getting liquidated. They would just emit more tokens, and so that was kind of where the yield came from per se. Now there's questions of like, where does the yield actually come from? So like for example, one of the protocols that a lot of folks reference, especially when when talking about unilateral exit, is Babylon. So Babylon is about 0.2%, and that is native yield. You own the keys, and that's like probably the most secure way to get like native BTC yield. When I say most secure, I mean like you don't have like bridge risk and you don't have like EVM risk, that sort of thing. Of course, you could lose your coins on the other chains, but generally you still own all of your keys. Now, moving down the risk stack, of course, you start seeing the bridged protocols, so bridging in sBTC, cBTC, WBTC, TBBTC. There's probably others that I don't even recall. Then you start getting into like bridge risk, and then but then you put the wrapped coins into different yield protocols, and the yield then comes from borrowing dollars, or typically it's borrowing dollars. It can be borrowing other things. So I guess it depends on how much demand there is to borrow dollars against Bitcoin. That's a very TradFi thing to do. We've seen miners do that. For example, CleanSpark posted enough BTC with Coinbase to get a $100 million BTC-backed loan from Coinbase. But that wasn't TradFi. That was, they deposited L1 BTC into one of the Coinbase vaults, and then they got dollars back. The reason I reference that example is just because that's kind of like the scale of demand that's out there. We're talking on the order of hundreds of millions of dollars. Miners would love to get billions of dollars. Miners are like one of the most capex intensive businesses in the world. The thing is, they a lot of times you have to over collateralize those loans, and so the yield then it gets diluted across the BTC that's being deposited, so that does drive yields down. The reason for that is to protect the lender. Most of the DeFi protocols that you'll end up posting your BTC into to get USD out will require an over collateralization as well, usually somewhere. Well, I guess if you go below 1, you'll end up getting liquidated, but typically most folks try to be in like that 1.5 to 2x over collateralization range. So it does become less capital efficient. And sorry, again, the reason I'm telling you this because it drives down to the demand for dollars, because I then have to post 2 BTC to get 1 BTC worth of dollars. I'm not actually creating new credit. I'm actually contracting credit, which drives down some of the demand. So anyway, all this to say, there's not a ton of super sustainable yield options right now for BTC. Again, BTC is sort of and L1 sort of a dead chain, unfortunately. There's not really a lot of activity happening there. Ordinals and runes are kind of a thing of the past now, at least as far as I can tell. And so there isn't a ton of like activity happening in Bitcoin L1. So if you want to start getting those yields, you have to move off chain, and then you start taking those risks and trying to, more or less get those dollars for the BTC. But I guess your question around how sustainable is the yield, hard to say at this point, because it's not clear what the driving, or it is clear what the driving factors are, but there isn't as much demand as we would hope for those types of activities. And at the end of the day, a lot of folks end up just going the TradFi route.
And Nick, with that, as a quick follow-up, how do you think about risk frameworks so institutions don't jump into the wrong type of yield product for them? And wrong might be, subject to how they are looking from a risk appetite to return appetite. But how do you put in that framework to guide institutions?
Yeah. Okay. So on the DeFi side, taking out Bitcoin, most folks go to like these protocols with, like, say they have USDC or USDT or some stable coin. They're looking for somewhere in the 8 to 12% range. That's kind of like, the sweet spot. Anything over that, and there's clearly something going on. Like if you're getting 14, 15, 16% on your stable coins, that means there's probably something else happening underneath the hood that's maybe not that great, that you don't want to deal with. It's kind of, that was the Terra Luna trade. They were offering 20% fixed yield. And of course, that's not sustainable. So in that 8 to 12% range, you can start to say, okay, maybe we're in a sustainable yield environment here for this type of coin. So that's one kind of like risk factor that miners, or I shouldn't say miners, pretty much anybody that's trying to get yield, DeFi yield, looks at, is like, what is the yield, and is it reasonable? So the 8 to 12% seems to be pretty reasonable on a stable coin basis or a USD denominated basis. Of course, USD has an inflation rate, which is what drives most of that. But then I guess in terms of like what the risk frameworks are for miners specifically, or other big BTC holders, as Adam mentioned, they do need to have like a really strong relationship with the counterparty, which does get you into more of the TradFi type of underwriting processes. So going out and making sure they have a strong balance sheet, they can pay back the loan, they have operating business that allows them to generate enough revenue to pay back that loan, that sort of thing. And there are some DeFi protocols that are trying to do like under collateralized lending, something like a Wildcat. I'm trying to think of another one that's out there, but they're trying to do that, and they underwrite the on-chain provider, I guess. They underwrite your on-chain persona and say, hey, this is like the profile of the company that's going to be borrowing the BTC, so we can actually lend to them more BTC than they're putting up collateral for, or lend them more dollars or whatever the lending currency happens to be. There is not a framework exactly for miners, or for not even miners, it's anybody. There's not really a framework, I would say. It's really fragmented. So I unfortunately, I wish I had a little bit better answer on what they are actually looking for in terms of framework. Yeah, I wish I had a better answer for you.
No, it's a great answer. I think that, again, it's just opening up the conversation to what's not really talked about very often, to those that are looking to begin educating themselves, as Stefan mentioned, around moving their BTC. And with my fictional 1,000 Bitcoin, it's good to hear these types of things discussed more openly, so that someone out there that does have a quarter of a BTC to tens of thousands of BTC can start to think about this internally in that operational procedure. And Rena, I want to come to you next. Thank you, Nick. Stacks and the entire ecosystem have begun to truly open up new ways for institutions to activate BTC without sacrificing security. And you leaned a little bit into this in your opening. Adam had talked about sBTC, as did Nick as well, and Stefan. But what are the specific workflows, continuing on that side of the house, that are becoming possible now that weren't possible a year ago when it comes to stacks really opening up that world of productive Bitcoin?
I'd say from our perspective, there's a few things that come top of mind, but there has been extensive R&D going on over the last, let's say, 6 months and going into Q1 on making sure we can respect unilateral exits. So Nick had touched on this, that Babylon is only one of the few protocols that have done that, and you can get a low kind of basis yield from it. The way that Stacks is really pursuing is that we actually believe that all BTC should follow suit if you're going to deploy it in our ecosystem. And so we're actively looking to reduce the bridge risk of actually bridging sBTC and actually just leaving your Bitcoin locked on the L1, where you have the cryptographic security to actually claim your Bitcoin if anything happens, whether it's through self-custody or through your chosen custody provider. I think this has been kind of the biggest research project that Stacks has ever taken on, because we fundamentally want to see people not only deploy their Bitcoin, but really move out of the store of value category to Bitcoin as your income generation revenue stream for your business. And when we kind of think about this a little bit further, you need a little bit more than trust me, bro, your Bitcoin's safe. Like, you just fundamentally need that. And we work with our custodians to make sure that if anything happens to the network, that there is a means to reclaim your Bitcoin. And I think that innovation of being trust minimized to going to trustless, there's been a lot of innovation kind of in that, from kind of all of the bridge projects and such, and all of the kind of new redemption designs. But that is, to me, the most fundamental item that we could solve for as Stacks. And as we go further, we hope that our consensus mechanism evolves with us going into this direction. And so you can see that we've even started updating our staking module of, not only are you staking with our native asset, but you're also staking with BTC, because BTC is economically more valuable. So we want that economic security backing our chain and backing our L2. And so the more and more we go in this directions, we believe that we can build trust with institutions, because we're building products that keenly address their concerns.
Thank you, Rena. And continuing with my fictional 1,000 BTC that I'm looking to make productive today, as I approach you and teams across the Stacks ecosystem to activate my 1,000 BTC, what are the top 2 or 3 requirements and gating factors that you may have that you're continually hearing again and again from someone like me looking to bring that 1,000 BTC?
I think the gating factors are pretty clear. One will always be security and the compliance behind it, but 2, on-chain liquidity. There is no point in bringing your BTC on-chain if the markets are not deep enough behind it to support the activity that you want to do. And so that's really what Stacks is working towards for next year, because to us, that's we want to see a world where you can swap, hundreds, thousands of Bitcoin in one go on chain without having to go through a centralized venue like an exchange. Like, that's like the world that we want to see, because that's what fundamentally a Bitcoin economy deserves. And so security and compliance, but really on-chain liquidity.
And Stefan, where do you see friction around yield and staking like products? As I noted, you got 2.5 million BTC in active public equities and financial products right now, about 160, 180 different treasury co's or the like. And so where do you see that biggest gap that is needed to be closed in the industry today when it comes to making Bitcoin productive?
Yeah, look, I think there's 2 types of things, right? Like, one was the one I already referenced, like a little bit education, to be able to make that internal decision. So I think, companies have to do part of their job, and we can help them with them to get ready. But then there's, of course, the other part of friction, that also Nick and Rena have addressed. And I guess, Adam knows firsthand, you often have to, move your Bitcoin around. The question is, do you bridge it or not? Do you keep ownership or not? And then I guess depending on what sort of solution, you want to deploy 1,000 Bitcoin in, maybe you have to get another token as well, to maximize your yields and understand how that, formula works, I guess, in detail. You guys are deploying or have deployed something like this as well, where I think don't get me wrong, right? Like, friction is not necessarily bad, but I think the complexity probably leads to people taking a little longer to make the decision. So I feel, Bitcoin staking, quote unquote, is just not as straightforward as for some other protocols, because it's, not native on the Bitcoin chain. But yeah, so I think the main friction really is the getting yourself to a stage where you are familiar enough that you think, hey, I'm now very confident that I'm not losing my Bitcoin and I will have a good yield product that I can utilize.
Thank you very much, Stefan. Last question as we come to close today's opening panel here in our new virtual series. What is the most realistic or high-packed milestone that you expect to see in Bitcoin capital markets next year, as we're just about a few short 16 days from the end of the year? Nick, let's start with you.
Yeah, I think so. We have about 225,000 Bitcoin wrapped today. Maybe we double that. So let's get to maybe 500,000 BTC wrapped in 2026. That'd be a pretty good. I feel like that would indicate traction on Bitcoin DeFi.
Love it. Stefan, back to you.
Yeah, I would hope that we actually see, a large asset manager, family office, bank, financial institution earn Bitcoin yields on chain. We've talked about lending, borrowing, all that stuff that's happening. I want to say the TradFi way. I really hope that we see this in a more, crypto native way. And I believe that could have a strong, like signaling and ripple effect, hopefully, just bringing others to consider this more carefully and looking at it and hopefully moving then alongside as well.
Thank you. Adam.
I had hoped this would be a 2025 thing, but I think it's looking more and more like it'll be a 2026 thing. I think, right now, as Rena alluded, right, I think Bitcoin from an institutional perspective is really looked at mostly as a store of value. I think to shift towards the utility component the institutions need, and I'll harken back to what Stefan opened the panel session with, was the idea of regulatory certainty. I think Clarity Act. Again, we're still early in the institutional adoption of digital. I think we're even earlier in the institutional adoption of DeFi for institutions. But I think having that broad framework that covers ecosystem infrastructure, I think we've made incredible strides as a broader ecosystem over the past 12 to 18 months. But I think that's the key unlock. We've long said, the institutions are coming, and I think that's more true now than it's ever been. And I think what that kind of broader sweeping regulatory environment or clarification helps provide is, helps facilitate what I think will be, the continued growth and the continued importance of the impact that institutional grade Bitcoin L2s like stacks have, and for the adoption of those.
Last but not least, Rena.
I think the milestone that I personally would chase on behalf of Stacks is that in 2026, right now, we're going to start the year with maybe $150, $200 billion of institutional capital in Bitcoin sitting in ETFs. Where I'd love to see that shift is actually going into corporate treasuries, the digital asset treasury codes, because they have a lot more flexibility to actually earn yield on chain or use other kind of staking mechanisms or things to actually provide a return for their Bitcoin. So I would love to see that 200 billion actually stay static for ETFs and the amount of BTC going to DATs actually increase.
I love it. Rena, Adam, Stefan, Nick, thank you very much for taking the time today to kick off our new virtual three-part series here about Bitcoin capital markets as well. Thank you all. And next up, we're going to be continuing this series into our next panel. And today, we're going to be talking next about the Treasury playbook. risk, security, and capital efficiency for institutional Bitcoin. Carrying on this discussion we just had today, and hopefully we'll hear more about how I can begin to move my 1,000 BTC into the world of productivity. Ladies and gentlemen, next up, our next panel, and Grant, the floor is yours.
All right, thank you, Kyle. Hello, everyone. Welcome to our interview with Richard Skeet from HiveMind. Richard, thank you so much for joining us.
Thank you for the invitation.
Awesome. All right, so we're going to get into it. This panel interview is called Treasury Playbooks, Risk, Security, and Capital Efficiency for Institutional BTC. But want to start off with a little bit of a discussion about HiveMind and your role. So just for listeners here, can you please just give a quick introduction on HiveMind and your role there?
Absolutely. I'll try and keep it brief. So I'm one of the managing partners over at HiveMind, alongside our founder and CIO, Matt Zhang. We are a platform that's digital native operators with very strong. Indeed, Matt and I go a long way back. We were in the trenches in the wake of the great financial crisis, slinging bonds around the place. So we've been doing that for a long time before I took a brief holiday and helped someone set up a hedge fund on the buy side for 10 years. But now we're back together. At the core of HiveMind is HiveMind Capital Partners, the asset manager. There, we are focused on bridging institutional capital in all of its tokenized forms using digital asset crypto rails. So bringing our DNA from the traditional finance side to bear action, both on assets in regular capital markets, but also clearly native digital assets and all those permutations where within. I myself am a technologist by original background. I used to be an app dev. I sometimes moonlight as a full stack Web3 dev. So I like to get my hands dirty, deploy code, and that's my preference before I move to the sort of the risk management side, trading side of things. But HiveMind, we're pretty busy from venture through liquid token trading, being one of the largest collectors and curators of digital art in the space, as well as on our broader platform outside the HiveMind Partners piece, digital asset orchestration layer in the form of Blueprint, our digital culture marketplace in the form of Lightyear, and we're even the asset manager for a digital asset AVAX One. So we're pretty busy. The firm is spread across the globe. I think we're 23 people now, from mainland China, Hong Kong, London, where I look after trading here, and then New York, but a few spread around North America. Matt leads the charge over there. We do the hard things up front. We're regulated by the SEC as an RIA, in the UK, the FCA. So we're trying to get ahead of it and realizing that clean, crisp operational excellence, strong risk management, these are the parts of the future. And I think very relevant for what we're talking about, the adoption of BTC and other assets inside corporate vehicles as digital asset treasuries and beyond.
Yeah, thanks for that. Makes a lot of sense. So yeah, just wanted to pause here on your background in TradFi. So you were a city trader for a while. Just curious how that's kind of informed your analysis of the crypto markets, or just like any of that experience. How has it impacted your current role?
Sure. So I moved over onto a trading desk just ahead of, and then earned my spurs through the crisis. So I was a bond trader. I used to trade securitized products, which is just a fancy name for the separation of the underlying cash flows of a thing, like a mortgage, an abstracted security that you can trade in easier form. Indeed, that whole business, and still a thriving business out there today. About tailoring a cash flow to meet a particular investor's demand, and you can do anything that your mind can think up. But of course, risk is just distributed. It never disappears, and that's a long way of getting to the point that a lot of the same problems that digital assets run into, leverage going awry, rehypothecation of assets, finding out that you don't own what you think you own, etc. Traditional finance has learned these lessons too, and yeah, I've seen many of those same challenges and problems before, and a lot of the pieces, a rather sad version of, but monetary Legos, that is what's slicing risk up and putting it into different pockets and moving it around. That's what it is. It just doesn't move as DeFi allows us to do. And certainly some of the challenges out there, with the likes of FTX and Luna, etc., our wariness of counterparty risk and who we're facing and what it is has kept us broadly safe, certainly outside of the initial car crash where the leverage and rehypothecation often come to pass. You'll always find them at the scene of the crime. So yeah, those are solid lessons that I wear as mental scars. But I will say have moved on from that life a little, because of course credit investing is always the downbeat. So like your best case in credit is you get your money back. It's very easy to lend money. It's actually quite hard often to get it back. And that's the problem with credit lending. Whereas, of course, digital assets, we're all focused on that growth, adoption, the network effect, and the right tail. It's a different mindset. So I try and bring the lessons with me, but not hold too much of the mental baggage from before.
Yeah, that's a great point. I feel that sometimes in crypto we're learning some of the lessons that have been learned in traditional finance for 200 years, and we're speed running them. So it's good to have your experience at HiveMind. So, while I have you here, I do want to hear some of your takes on like the broader market. So the kind of fundamentals look really good on a regulatory front. You're seeing big deals with Stripe and some big banks coming into crypto. But is the 4-year cycle over? Why isn't this being reflected in the price? Not to harp too much on price, but it is. I do want to get your perspective here.
Yeah, it's the number one question that always gets asked, and every single time I attend a risk takers dinner or the like without talking about price. What's the next big thing for? Well, price. The world has changed. Yeah, this time is different. Incredibly dangerous set of words in finance of any kind. I think that overall attention spans, mine too, have become filled by the sheer speed of information that is thrown upon us. Taking the step back, the progress has been immeasurable. The idea of 13 months ago to now that the SEC would put out guidance of how to self-custody assets is quite a phenomenal change. The fact that stable coins are going to be part of the DNA of traditional finance through time, that forcing many of these markets to open more hours through time, to remove counterparty risk through faster settlement cycles, etc. The unlocks that this will enable are ginormous. I don't think people necessarily realize how big a burden it is for a traditional finance institution to have T+1. Used to be T+3 when I started, but even having 1 day of jump risk that the other person might not be there, versus streaming payments or settling on 10-minute blocks or instantaneous payments, it creates a massive amount of capital freed up that can be redistributed and push the system on. Unfortunately, at the same time, there are lots more new shiny toys, whether it's prediction markets, which have become the new plaything for sure, the new product market fit, if you will, for crypto, or NFTs as they went before them. Again, there is lots of great value in these ideas, but often they get financialized and take views that perhaps are short-lived. Capital is very fungible and fleeting, and when the names in traditional finance are growing so fast, getting people's attention on price going down is hard. Right when people should be thinking about investing, the least likely time they will. This is just human nature. These are the regular cycles of it. But to answer the question, the 4-year cycle, I think I don't believe the 4-year cycle holds as it used to hold, simply because the capital base involved, the participants involved have changed. It is hard to, you heard on the prior panel, it is hard to believe that that amount of capital in the ETFs on the balance sheets of treasury companies. This is a huge shift from where we were 4 years ago, 8 years ago, etc. The 4-year cycle made a lot of sense when it was just the same smaller pond of people dabbling in it. That hopefully should continue what we've seen in the volatility space. So volatility and options trading is an important set of signals for any trader or otherwise. We have seen implied and realized volatility come down progressively in Bitcoin. An asset that would have been 60 to 80 vol, is now in the 40s regularly, and in summer in the 30s. This just shows the change of pace of the space. Some of that is coming from the participants, whether it's miners hedging, overwriting, covered calls, etc., to generate yield. But that shift is real and very, very tangible here. So whilst we may have lost some of the volatility, works in both ways, I guess, where I'm trying to take this, that as vol comes down, that should mean that the bear markets are shallower. It may mean that the explosive moves to the upside are shallower too, within reason. So I think that the 4-year cycle is not one that I fear anymore. We are still here. It's definitely still going. The price will go up in time. Watching precious metals fly, despite the correlation with Bitcoin being so low, near zero, in fact, this year, which is a bit of a narrative break for us all, that in time, nothing stops this train. Governments around the world are printing more money. People want scarce assets, whether that's fine wines, cars, arts, Bitcoins. Like, people want these things, and the normalization that will occur as stable coin rails are just everywhere. That once you've got people over the line owning a digital asset, owning a different digital asset that has an orange color, I think they're on board with that. And so I think the mass adoption wave comes from fixing the really boring stuff, the plumbing. And I know we've had many people trying time, but they're normally trying to take quite a big fee for it. I think as those fees get eroded away, then it becomes very, very normalized. Hopefully that's answered most of the question around the houses to end up at the end point.
No, it's a wide-ranging question. You can take it a lot of ways, but thank you for that. But you did mention, someone interested in purchasing Bitcoin are the Bitcoin treasury companies. So I just want to start to weave the conversation in this way. From your perspective, kind of boots on the ground, looking at some of these Bitcoin treasuries, just getting right into the weeds of it, have you started to see these Bitcoin treasuries looking more into kind of like a DeFi, or taking the next step of not just acquiring the Bitcoin, but putting it to use? We'd love to hear kind of your perspective on this front.
Absolutely. So this year I have underwritten 96 different digital asset treasury deals. So we've seen a few at this point. That doesn't mean we've invested in them all. But just
Yeah.
going through the documents, meeting management teams, etc. Included in that is a large swathe of Bitcoin focused treasuries there. I think that the playbook has been evolving for them. That day one, it was just a food fight frenzy. Get out the door, raise as much capital as you can, buy at the lowest price possible, get ahead of anyone else buying because you know there's a conveyor belt coming, so you want to buy. And I think some of them rather missed the point. Those in the heat of battle, that can be the hardest to keep the cool head. But those that will survive are the ones with the big plan, with solid governance. What are you buying? When are you buying? And how are you buying? How are you going to custody this? How are you going to differentiate? And that is where we get to the point for me. We are regulated investment manager here. I keep repeating it like a mantra: do the hard things up front, and key management and deploying in DeFi. These are things very comfortable to us because we put a lot of focus on it. Corporate with sometimes only a handful of people there pivoting from one to the other to be fully familiar and to put into place all of these parts. So worrying about being a public company, fulfilling their requirements for the auditors, filings for the SEC, making sure everything will come to pass for accounting. It is a nightmare. So they have often, my experience, they've often said that they intend to earn yield, and there's been a lot of hand waving about what that actually will be. So I have been underwhelmed as to how quickly they will be getting out there. However, if anyone would like to talk to someone about it, very happy to offer our services. We can do that. Small plug. We have strategies and solutions for that. It's an important thing to, again, governance, but risk management, to understand what are our constraints at that corporate level. How much cash do they need for operating expenses to keep the business alive, keep all the filings filed and the auditors paid? Do they want to use debt? Their capital structure. Again, if you believe that Bitcoin will only go up and to the right and will never dip again, of course the answer is to borrow as much as possible and buy as much as possible. But that is not prudent. That is how you likely upset your shareholders, who are your owners, and that is a problem. So I think we will generally see people get there. We often use the mantra of crawl, walk, run. You've got to get the basics in place first, but you have to, again, back to that mandate and the governance. What is it your stakeholders think you're going to do? Are you intending to keep it pristine and clean? They just want you to hold it, which likely means you're going to be burning capital every single year. And if that's the case, someone has to fund that. So you have to have a plan for how you're going to pay for those things. If they want you to earn yield because you're doing some borrowing and lending, or you're supplying capital to the Bitcoin miners to help secure the network and playing in hash rate markets available out there, that's fine, but people need to understand what risks you're actually taking. So to answer again, or refer back to my answer at the top, rehypothecation risk, credit risk, counterparty risk, you're only ever paid for risk, and so you have to take it somewhere. Our preferred is a more quantitative market-led approach through, for example, basis trading and covered calls on regulated cleared exchanges where possible. Do it in a very buttoned up manner, in a way that you can very much define what your counterparty risks look like. But you need the right toolings and setups to do that. That's not they don't sell that at Walmart for you to plug in and turn the key. You need to have some specialism around there.
Yeah, that makes a lot of sense. I've been doing more personal research about just some of the covered call strategies and other ways to earn yield with BTC in that way. I kind of bucket that in one area of a almost reliable way to earn a yield with BTC. Just curious, are there any other yield opportunities with BTC that you're seeing at HiveMind that you're considering
Sure.
deploying?
Yes, the the hardest one to get going well is of course the full-on DeFi world, and
Right.
that is the ideal place for a digital asset treasury to help, because they have that stickier capital. But it is chicken and egg in size and capabilities and certainty. There. I mean, there is just the good old-fashioned basis trade
Yeah.
that take my unit of BTC, throw dollars against that. I buy another unit of BTC, and then I sell the future against it, or the perp against it, and I just trade out my implied funding basis. And the right answer, right? Let me put quotes around right, because it clearly depends. But you need a way of knowing what type of market regime you. Bitcoin has this tendency to trend in its price. So if you are in one of those stages where we're having an aggressive move up, you don't really want to be selling covered calls. That's not a particularly smart way of doing it. But at that point, there's likely a large demand for leverage, which means what you can get paid on basis is much higher. Similarly, if you're in a downtrending market, because we're in our 4-year end of the 4-year cycle bear market, or otherwise, then covered calls are pretty attractive, because you can get paid much more than you really should for the risk you're taking. And being able to be nimble between the two, I think that's where the real alpha and the juice is. But again, a corporate treasurer isn't going to be sat there, the CFO, saying, "Oh yes, let's do these things," because someone's going to get their knuckles burnt at some point. So hopefully there's room for. I do hope that as more institutional players come in, that these sorts of toolings can become more and easier out of the box. I think that part of that, though, is, again, I hate to keep harping on about boring stuff like SOC type audits, or some SOC processes that everyone understands that if I follow it in this way and I go and get my yield in one of these 3 buckets, auditors will not give me a hard time. Like, knowing that up front is hugely valuable, because sometimes it's just the juice isn't worth the squeeze. You think you're going to be getting a little bit of incremental yield, but actually you're making yourself a nightmare of pain behind it.
Yeah, totally makes sense. And this, that boring stuff is kind of the ticket to some of the institutional adoption. So it's definitely necessary. It makes complete sense. We got to do the hard work, like you're saying.
And we're making great progress. I mean, even something as simple as an accounting unlock, moving to fair market value accounting, so that it works as an asset on your balance sheet. That's a huge unlock, but it's the sort of thing which goes past without much fanfare in the digital native side of the world. So I'm very excited from it. Think that more of these opportunities will come. Cautious earn yield, or how we'd advise people to earn yield. It's a more mandate-driven, bespoke conversation as to what risk someone is comfortable with and how and why. But an important tool that needs to be in the toolkit, because otherwise, how do you keep the lights on? How do you keep growing? How do you keep your fundamental mission of growing BTC per share?
Exactly. Well, Richard, we could talk for hours here, but unfortunately, I realized that we ran over our time slot. So just want to close this out with just like a final forward-looking question, maybe into 26, 27.
Sure.
What do you think, what do you think is going to have to change to unlock these Bitcoin treasuries to take the next step to make the Bitcoin productive? Like, what do you think is going to be the big sea change that's going to really start to unlock this capital? Maybe paint that picture for the next few years.
Sure. So a little bit of doing the hard stuff up front. So again, SOX style controls, auditors being on board, public company, all of those declarations, the regulatory regime, which is moving absolutely at pace in the right direction, but just finalizing that. I think we're way that those are great things. I suspect that there will need to be a little bit of consolidation. Hopefully, that doesn't come across as too offensive to anyone, but there needs to be a way of unlocking these discounts that sit there. Where the MNAV is below 1, I think that will come, and then it's a little bit of chicken and egg, but as people go first and as more yield is generated, you will open up easy to subscribe to funds that will then just accumulate assets and deploy them out there. At the moment, everyone is stood there watching each other. Who's going to go first? How are they going to do it? They're dabbling in small sort of traditional lending and borrowing type protocols, moving into more managed option overlays, trading overlays, basis trades, etc. I think will open up, but it'll start small, and in a couple of years' time, I think we'll look back and be surprised that it wasn't obvious and done out of the gates.
Yeah, that makes sense. Well, Richard, thanks so much for the time here. This has been a blast. Really appreciate all the candid insights and your perspective. And just to close it out, anywhere people can find you online, and then we'll hand it back to Kyle.
Sure. Hivemind.capital is our website. It's about to go through a rebrand, so go fast if you want to see the old one. And you can check us out on all the usual social. Certainly, if anyone has an interest in digital art, they should check out our Twitter handle, as there's always a steady stream of great content there. You can find everything from our venture, our trading team, but all the way through to digital art. So pretty well-rounded, pretty active in the space, and always love to talk. Thanks for the time.
Awesome. Thanks, Richard.
Everybody, welcome to our next panel here on unlocking yield. I want to get right into it. We have a lot of meat to go over. So let's start with introductions. I am Jason. I proudly represent Stacks Labs, doing the communications and PR for our team. And we have a really great panel here today, so I don't want to waste any time. Maybe we start off with Jacob with introductions.
Yeah, absolutely. Hey guys, I'm Jacob, CEO and founder of Hermetica. We are building institutional grade Bitcoin yield products. We have our first product, USDH, live on Stacks for the last 18 months. That's a Bitcoin-backed yield-bearing stablecoin. And we are in the process of launching our second product, HBTC, which is a Bitcoin on Bitcoin yield product. And it's coming in the next couple of weeks. So yeah, that's me. Hi, everybody.
Amazing. And Yuri, we'll go to you next.
Hey everyone, thanks for having me. I'm Yuri. I'm head of product over at Swike. At Swike, we are one of the infrastructure providers for the entire ecosystem, and specifically our roots are in the Bitcoin ecosystem, as we have been one of the largest Bitcoin miners in the world. We used to be the biggest Bitcoin miner in Europe in 2021, 2022, and eventually we expanded more towards staking. So this is where the connection is coming from.
Amazing. And Andre, last but certainly not least.
Yeah, good morning, everyone. My name is Andre Serrano. I lead product for Stacks Labs, where I primarily built sBTC, which is our one-to-one Bitcoin-backed asset that allows you to use Bitcoin in DeFi and smart contracts. Also the development of our first Bitcoin staking protocol known as dual stacking that allows users to earn Bitcoin denominated rewards for securing the Stacks network or bootstrapping the DeFi ecosystem around it. At Stacks Labs, we've been spending a lot of time thinking about how best to offer safe, sustainable yield for institutions. So happy to get into it.
Yeah, and on that, Andre, I want to go back to you. Could you just go over, maybe we start at a high level, and let's talk about some of the recent or strongest misconceptions when it comes to Bitcoin yield.
Sure thing. So I guess we can start at a high level, which is that really we're starting to see a shift in the Bitcoin ecosystem where institutions are looking for ways to move their Bitcoin out of cold storage and actually make it a programmable asset and start to integrate those workflows to really start to generate yield or income on the Bitcoin that's held on their balance sheets. And so what this really means is that Bitcoin is becoming a productive collateral asset that allows you to earn protocol rewards, again, from either securing the network, contributing to the growth of the ecosystem, or by participating in various on-chain strategies such as options, derivative strategies, or different sorts of Bitcoin yield vaults. And so, yeah, we're really looking at ways that we're to integrate this sorts of programmable Bitcoin yield into the allocator's existing workflows. And so looking at ways to really make that seamless and try to go through the institutional due diligence process that a lot of these allocators have when participating in Bitcoin.
Amazing. Yuri, I want to go to you, as I know Spike focuses on secure structured BTC yield. What kind of yield products are institutions actually taking an interest in right now? What's really driving the demand that you're seeing?
So right now it's pretty obvious as we have started to see this development in 2024, late 2024, and in the beginning of this year are DATs, simply because they are very regulatory friendly. You have a lot of regulatory clarity on that. This is why institutions really love this product. That being said, one big issue is that now we have like so many DATs in the market. We are counting, I believe, like more than 150 DATs that try to accumulate more liquidity. So this is a very uphill battle that each DAT issuer has to fight right now. So what we are seeing right now is that these DATs become also more advanced in terms of yield generation. So what they are trying to do is that they make the Bitcoin, so to say, more productive. The most common one, also because it's very much aligned with the regulatory guidelines that are in the US, are obviously covered calls, where a DAT issuer can basically sell a certain call option in exchange for a certain premium. So this is like something that we have seen quite a lot, but now that we also see like more products in the Bitcoin yield ecosystem, we also believe that also these tools are getting more adopted.
I want to stick on this topic of DATs. As you mentioned, Jerry, there's so many, and they're all looking for ways to take that next step. Jacob, I want to pass it over to you. Hermetica, I know, is building new Bitcoin native yield primitives. What's become possible recently that simply maybe wasn't feasible before now and into 2026?
Yeah, that's a great question, Jason. So in our view, we now have all the building blocks in place to create a Bitcoin yield product user experience that is fully Bitcoin native, meaning the user can show up with native Bitcoin, can deposit native Bitcoin, and then when he wants to withdraw, get back native Bitcoin. And on top of that, that product can be non-custodial, meaning the user retains the only ability to withdraw, and it is fully transparent on chain. And so the building blocks to make that happen are, one, a wrapped Bitcoin version like sBTC that is non-custodial, decentralized, and so as anybody can access it. There's no fees. It's very low latency for Bitcoin, that is. And then on top of that, a Stacks DeFi ecosystem or a Bitcoin DeFi ecosystem that is really battle tested and has the core primitives in place: lending markets, trading venues, and dollar yield sources like our own USDH. And if you combine those three elements, really, wrap Bitcoin, DeFi primitives and yield sources, you can create a Bitcoin on Bitcoin yield product that is non-custodial, that is fully native to Bitcoin, meaning the user experience is Bitcoin native, which I think is important. And then lastly, and probably most importantly, and we can talk more about this, is transparent, in meaning that you are, as the user, understand, one, where the yield comes from, and two, what the risks are, and you can underwrite it in an institutional way and really keep track of it in that way. So those are the elements that are in place, and that's wrapped into HBTC, right? That's our product that's coming online in the next couple of weeks. I want to plug it here also because it's going to be exclusive to our waitlist. So if you want to be part of HBTC, it's going to roll out in the next couple of weeks. Early January is what we're looking at right now. Head over to hermetica.fi/waitlist. It's going to be exclusive to the waitlist. It's going to have probably 10% plus APY at launch. So yeah, head over there, hermetica.fi/waitlist.
Squeezing all the alpha in right before the end of the year. I love it. I actually want to double tap on that with you, Jacob, on the transparency. But going back to the idea of non-custodial and the benefits of non-custodial towards institutions, maybe at a high level, and anybody else is welcome to answer as well. What is the importance for these institutions to have non-custodial options?
Yeah, I mean, at the end of the day, any yield product, especially on Bitcoin, we believe is all about risk-adjusted yield, meaning it's not just about how much yield can you make, but what is the risk that you have to underwrite to do so, right? We all love our Bitcoin. We all love it in cold storage. But we're getting now, as we talked about, into a new phase where we want to make that product or that collateral productive. And so if you can have a non-custodial element to the product, that just takes out a huge element of the risk, meaning you know that the protocol cannot simply withdraw your funds and misappropriate them and have that assurance. And on top of that, the transparency really allows you to understand, as I said, what are the risks, what are the yield sources, and then track that in real time, right? You don't have to trust Hermetica or another protocol. You can actually look on chain and see that happening in real time and do your own due diligence and ongoing tracking of those products. And so if you combine those elements, non-custodial element, transparency element, you just make the product less risky, in our opinion, and therefore it makes it a higher risk-adjusted yield.
Absolutely. Andre, I want to go to you now on the Stacks side of things. From the Stacks perspective, what new workflows are emerging for users and institutions to really activate their BTC through L2s and even in DATs, like we talked about with Jacob here?
Yeah. So on the stack side, we're really looking at ways to enable more protocol level rewards to start to earn Bitcoin denominated yield. And so with Stacks, we recently rolled out our dual stacking product that allows you to earn Bitcoin denominated yield. Again, that Bitcoin native yield source that Jacob was mentioning, where you can actually earn rewards by securing the Stacks network or bootstrapping the DeFi ecosystem around it. And one of the interesting things about this model is that in this case, sBTC is essentially acting as a liquid stakes token in many ways, where you can essentially deposit your Bitcoin, mint sBTC, and start earning protocol level yield sources through this, while also being able to deploy that Bitcoin into DeFi. And so it starts to get really interesting when you combine this with the Hermetica yield vaults that Jacob was mentioning and other DeFi applications, because allocators can earn a base level of rewards for doing that, while also boosting their rewards by participating in the DeFi ecosystem, whether it's through the on-chain yield vaults, again, that Jacob was mentioning, or through different Bitcoin yield aggregators that are available. And so, yeah, really looking at providing, like integrating these sorts of yield sources, whether it's at the protocol level or at the application level, into the existing workflows that these institutions have, making sure that it fits within the custodial frameworks that they have. This typically goes through a traditional institutional due diligence process. They want to know who is the counterparty, what are the risks that you're taking, and so the more that we can integrate that directly, I think makes this whole process a bit easier.
Amazing. We've been talking about some stuff that's emerging. We talked about some stuff that's launching, before the end of this year. I want to back up to a little bit of a high level here and ask all of you, we can take turns. Where are you seeing the safest and most sustainable yield sources right now for Bitcoin? Yuri, maybe we start with you and kind of round robin.
Of course. Yeah, I mean, besides the dots that I previously mentioned, we are, I would say, like the most straightforward way to look at it is to see what has worked in DeFi so far, very reliable, and that's, for example, over collateralized loans. So basically taking like the money Legos that we have seen playing out in the Ethereum world throughout the past couple of 5 years, and also bring that one to the Bitcoin world. And from what we have seen when talking to our partners in the Bitcoin ecosystem, even that is already exotic to them, because keep in mind that generating yield on Bitcoin is still something novel. We're talking to people who just invested into Bitcoin and were like completely fine with just holding it along the way and use it as a hedge against inflation. And now with these new tools, even over collateralized loans are something that sounds alien in the first place, but becomes more and more interesting to the people that we talk to. So I would basically say that look at what worked in the Ethereum world for like a very long time, and see how it can play out in the Bitcoin ecosystem as well.
Jacob, Andre, anything else to add here on sustainable sources?
Yeah, I think I look at it from, I see three main elements. There's others that are coming online, but if you look at the biggest yield source in general, also in the traditional world, those are derivatives markets. So these futures, options. It's a market that is very significant and growing. And so can one have sustainable yield, but also scalable yield, meaning you can deploy billions of dollars into those markets and generate yields. These are strategies like basis, which obviously underpins USDH, but also volatility, inter-contract arbitrage, etc. These are mainly off-chain at the moment. There are some on-chain yield sources or derivatives markets now, like Hyperliquid, but they're mainly off-chain. So these are on Sexes and other trading venues in the traditional finance world. The other major element that is coming online and is very exciting, I think, are credit markets. Yuri mentioned over collateralized loans. There are now credit instruments like Stretch from Strategy that allows you to generate yield on a dollar basis against Bitcoin. And you can think of these credit markets as mainly dollar yields, but you can harvest these yields into Bitcoin. That's what we do with HBTC, where the Bitcoin is collateralized and borrowed against, and then the borrowed dollar value is deployed into credit instruments, and the delta between the borrow rate and the credit instrument's return rate is then harvested back into Bitcoin. So any credit instrument that is maybe 10+% APY is a very interesting yield source for Bitcoin, in my opinion. And you have Stretch, you have other more exotic credit instruments for maybe USDAI is, for example, a credit instruments that lends against H100, so like AI data centers. And that's all coming on chain. And lastly, and this is what Andre has mentioned, is these are Bitcoin yield products that are part of consensus. They generate yield from transaction fees. So the dual staking system from sBTC. I think those are new and very interesting yield sources for Bitcoin that are completely unrelated to derivatives markets or credit markets.
Amazing. Andre, do you have anything else to add to that?
No, I think Jacob covered it.
Awesome. I want to talk a little bit about custody, counterparty risk. We haven't gotten into that too much here. And I know it comes up a lot when users are exploring this yield journey. Open to anybody who wants to take it, but how are you and your organizations really thinking about addressing these concerns?
At least for the on-chain deployments of Bitcoin, we built sBTC as a secure federation, meaning that the Bitcoin is secured by a decentralized group of signers that are economically motivated to high uptime and performance. Currently, there's 14 signers that secure the Bitcoin that's held in the protocol, and it requires a 70% quorum for any Bitcoin to move in or out of the protocol. At this point, sBTC has been live for a year, and so it is getting that sort of battle tested, more battle tested each month that it is live in production, and so it's a great source of it's a great way to start to make your Bitcoin programmable today. But we're also looking at ways that we can start to future-proof this through more self-custodial Bitcoin models as well. I think that one thing that we've learned in speaking to many institutions on the topic is that the custody model for the underlying Bitcoin is very important, and having that ability to unilateral exit if you're deploying your Bitcoin on chain is I think will be a big unlock for really enabling billions of dollars worth of Bitcoin to come on chain. And so that's really where we're focused on a lot of our R&D efforts right now to be able to satisfy that. We're seeing that institutions really care about self-custody and the trust assumptions that they're taking for moving their Bitcoin on chain. And yeah, I think that's really where the focus is right now.
Andre, I want to stick with you for a second here and go deeper on the idea of, as capital markets for Bitcoin are maturing, working at Stacks Labs, what shared infrastructure or collaboration do you think matters most as we expand what opportunities there are for Bitcoin yield?
Yeah, I think that the custody providers play a very important role for bringing many of these institutions on chain, because one thing that we've learned is that institutions really care about who their counterparty is, because they have legal agreements with these providers, that they offer insurance in many cases, and it just fits into the existing workflows, going back to the original previous question, that they're already familiar with. And so they have everything set up in their reporting systems and auditors and things like that. And so, at Stacks Labs, we've been really focused on working very closely with institutional grade custodians to be able to offer these sorts of structured products, both at the protocol and application level, to these institutions that want to start participating on chain.
Amazing. I realize this is such a big topic, right? And there's so much meat, and we can carve it 1,000 different ways. And I know we have such a limited time. Yuri, maybe I pass it to you. I want to kind of get into a little bit here, just like the biggest barriers to broader adoption for Bitcoin yield as it stands now. You can tackle this from regulation or education. Maybe it's liquidity or UX or something else. We don't have to tackle all these, obviously, because like I said, we could have a whole other webinar series on these. But if there's any that stick out to you, what do you think is a big, big barrier that we need to start thinking about in the short term?
Yeah, I would say number one thing in order to be more successful in education is specifically the terms, because to be very honest, I was like very surprised when the entire meta around Bitcoin yield took off, that people used to confuse a couple of terms. So people were like talking a lot about how to get yield on native Bitcoin, even though the tools provided always included a synthetic version of it. So I was always like surprised how all of the people who already suffered from various DPEGs and smart contract exploits are throwing around terms that are not 100% correct. And in order to also be more successful on the regulatory side of things, I think it's very, very important that we stick to the right terms. And I think then we also are a little bit more successful on the educational side of things. Because if I look at it now, and when I get pitched, when people pitch me their synthetic product, it's always that I try to correct them a little bit and say, look, the moment where you bridge something or wrap something, it's not a native BTC anymore. But on the bright side of things, I think there's a lot of appetite for these Bitcoin yield products. And I think we just need to figure out the entire educational part. And then I think that there can be a massive, massive wave. And I believe we'll also talk about this a little bit later. It's like what could drive these adoptions. So yeah, pretty bullish, so to say, on the outcome, but we need to get our homeworks done before.
Yes, it's a great segue to, I think, what I wanted to get to next. So Yuri, maybe I just throw it back to you of what is this bullish case? Like, what is the milestone or breakthrough that we need to have meaningful expansion for Bitcoin opportunity?
I mean, the amazing thing is that we already achieved so much on the institutional side of things. So I think we will just see this rolling over the next couple of months and years. So I'm very optimistic about that, and I don't think that there's still a lot to be done, because there is clearly an appetite for digital assets, and especially Bitcoin, also on the institutional side. So if we compare this to 3 to 4 years ago, when Bitcoin was still a very alien asset to a lot of these institutions, like, we have come a very long way. But what I found like interesting when I like worked in Turkey 2 years ago, in Argentina, now you also hosted the Hacker House there. It's like, I think this is like the best, or like the biggest driver on a very broad adoption side, when we really talk about people not only buying Bitcoin and investing into it in order to hedge it, but that it becomes their standard of life. Just like a super quick story, like I worked in Turkey in 2023 for a year, and on some exchanges there was like the volume was so tight, and if we compare to the Turkish lira, we actually saw already Bitcoin reaching almost $1 million in Turkey, because the demand for Bitcoin was so high compared to the local currency, because the local currency inflated by 50% over 1 year. So if we basically take these puzzle pieces that we have seen in the crypto industry, where we say, okay, we take the Bitcoin, which is by far the strongest asset in the industry besides stablecoins, of course, and provide the people with the right tools in order to now also achieve yield on it, then I think we are getting very, very close to what we have envisioned to achieve 10 or 15 years ago. So I think this is like really the last tiny catalyst that is missing to achieve greatness.
Absolutely. Bullish just listening to that. Also love the shout out to Dev Connect. The Hacker House there went off great. If anybody was there, if you know, you know, it was a great time. Jacob and Andre, I'm going to give you the same question in 2 different ways. Jacob, I'd love to start with you. What's one piece of advice you'd give somebody who's exploring Bitcoin yield for the first time? Somebody who is just wanting to get into it. Maybe they're crossing from another L1. They're looking to take their Bitcoin out of just holding mode and get into yield.
Yeah, I mean, in general, as you want to engage in any investment or yield strategy, I think you need to do your research. You need to do your homework. You need to really understand what you're engaging with. Anything that is different than holding Bitcoin on main chain and just in cold storage has a higher risk profile. And I think that needs to be fully understood. So understanding, where does the yield come from? What are the risks that you're underwriting? What can go wrong? What are the edge cases? And really digging into documentation and any information that the protocols provide. I think there's a lot of work that needs to be done, to be quite honest. I think a lot of that is quite opaque at the moment. That's something that we want to change and are working really hard on to change, to make it really as transparent and clear as possible. The other advice I would give, which is maybe counterintuitive because I'm a provider of a Bitcoin yield product, is only use a small percentage of your Bitcoin, because the ecosystem is young. There are risks. There's a lot of very interesting experiments that I think are worth exploring and deploying into and having some skin in the game. But at the end of the day, Bitcoin is a generational investment, and you don't want to put your whole stack into that and potentially lose that. So those are my 2 pieces of advice.
Great advice. Andre, I want to give you the same question, but from the perspective of a builder wanting to start building institutional yield products. Where would you have them start?
Yeah, it's a good question. Yeah, I mean, I think it's very similar. Like, if you're a builder looking to get started building in the Bitcoin space, it's very important that you select the right infrastructure and service providers around that. And so really understanding like what are the tools that are available for you to start building in the ecosystem, what kind of resources do the ecosystems provide you to get started. I know you mentioned things like whether it's the Hacker House that Stacks Labs hosted last month, or the documentation that's available, other sort of developer-focused initiatives that we have planned upcoming. I think all of these things can help developers get started in building on Bitcoin and help them sort of select the right ecosystem for their Bitcoin yield product.
Amazing. As we wrap up here, I just want to say, Andre, Yuri, Jacob, thank you so much for participating in this and talking about what it means to unlock Bitcoin yield. Honestly, I'm excited to do this again sometime in 2026 with all three of you, and let's see how far we've come even in just that short a time. I think it's going to be great. To anybody listening, make sure if you're interested in any of these projects, any of these people, you can follow them all on Twitter, follow their projects, see what's going on with Bitcoin yield. Otherwise, thank you so much, everybody, for participating.
Thank you so much.
Thank you.
What an incredible day one of Bitcoin capital markets. We had panelists from all parts of the ecosystem, whether that be in the institutional side, service provider side, the layer side, and so many more. Thank you all very much for tuning in, and thank you, Grant, and thank you, Jason, and all of our panelists for taking the time today to share with us what's happening across Bitcoin capital markets. I am, for one, excited that my 1,000 BTC we talked about earlier is now able to be productive in so many unique ways. And we look forward to welcoming all of you and others back here on Wednesday, December 17th, for part 2 of this webinar series, as we begin to look at the areas of dual staking to wallets in custody, and also how to participate in the future of Bitcoin staking as well. That said, everybody, I'm your host, Kyle Lacotte. Thank you very much for joining us here at Bitcoin Capital Markets, our institutional series about how to take Bitcoin from an idle, sleepy asset to a productive asset across any application and or portfolio. Everything here discussed today was for educational purposes only. Please make sure to do your own research. Nothing was financial advice, and we look forward to having you back very soon. Until Wednesday, everyone have a great day. We'll talk soon.